The market efficiency theory actually has three different degrees of market efficiency, and we'll talk about each of those degrees, but it basically, each one says that market prices reflect a different amount of information. And whether or not market efficiency theory holds and to what degree it holds, that's really important. It's more than just an academic exercise. It's important for investment strategy. It's important for financial markets. A couple of the key questions is what's the best way to regulate financial markets? The level of efficiency will have an influence on that. One of those that's relevant to probably everybody who's listening to this right now is as an investor, should you do some yourself or pay somebody for technical analysis or fundamental analysis, thinking that the resources spent can help identify winners and avoid losers? Or, as we'll see, that may not be possible, and the money and time spent are just unnecessary, and we're better off simply buying a little bit of everything, not trying to pick winners, not trying to pick losers, but just be diversified. So there's some real implications to understanding the theory, and in particular then being able to draw some conclusions as to how efficient we think markets are. So as I said, there's three degrees, and the weakest one is called weak form efficient. And a market is weak form efficient if prices reflect all public trading information. However, they do not reflect all public non-trading information or all private information. So what does that mean? Well, the key implications are that there's no predictable benefit from technical analysis. So if you were to go out and look at the charts and try to identify the patterns, anything that you might learn is already reflected in the price. So you couldn't predict where things are going in a way to, quote unquote, beat the market, because anything that's in there is already reflected in the price. However, there is potentially a predictable benefit from fundamental analysis. You could scour the other public information, the balance sheets, the income statements, the industry reports, find companies that are undervalued to buy or overvalued that should be sold. There is also a potential benefit from insider trading. Again, it's illegal and unethical and so shouldn't be engaged in, but from a theoretical perspective, there is private information that if one knew about, one could predict that which stocks might go up and which ones might go down, because when this private information became public, people would reevaluate their assessment of the companies. If a market's not weak form efficient, then the prices do not reflect all of the information contained in past prices. It doesn't reflect all of the past trading information, and therefore there is potentially a predictable benefit from technical analysis. So that's an important distinction between weak form and not weak form. The middle degree is semi-strong. In many ways, this is the most interesting. This says, in a case where you have a semi-strong efficient market, market prices reflect all publicly available information, so both trading and non-trading, but not private information. So the implication for here is that there's no benefit to either technical or fundamental analysis. That looking at the charts isn't going to tell you anything, because any pattern that you may identify, the information embodied in that's already reflected in the price. Likewise, because all public information, non-trading information, is reflected in the price, there's no predictable benefit to poring over income statements and balance sheets and industry reports and demographic data, because anything that you would learn about where the company's likely headed or where the stock's likely headed is already reflected in the price. However, because private information, not all private information, is reflected in the stock, then there is a potential benefit from insider trading. Again, it's illegal and unethical and shouldn't be engaged in, but if one had access to private information and knew that kind of good news is coming down the road and one bought the stock, it's reasonable to expect that that stock, when that private information became public, would do quite well. If markets are not semi-strong form efficient, then the key implication is that there is a potential benefit from fundamental analysis, which is, again, if markets are not semi-strong form efficient, means that you could pour over balance sheets, income statements, and other types of public information and identify stocks that are undervalued that one would want to buy, or stocks that are overvalued that one would want to sell. And that's why I think that semi-strong form is a particularly interesting one to really try to understand, because so much effort, so many resources are spent on fundamental analysis that, depending on whether markets and to what degree they are semi-strong form efficient, tells us something about how well those resources are being allocated, and should they be spent doing fundamental analysis, or would they be better used elsewhere. Finally, they're strong form efficient. This is the most stringent, and basically here prices reflect all information, all publicly available and all private information. The implication is there's no benefit to any of the three types of strategies we talked about. Technical analysis, anything embodied in the patterns already reflected in the price. Fundamental, anything you could learn from poring over public records, public statements, financial statements, is already reflected in the price. And even if you knew private information, even if you knew tomorrow the company was going to come out with the greatest news ever, that it just won the biggest government contract in the history of government contracts, there wouldn't be a benefit to that, because that information is already reflected in the price of the stock. If markets are not strong form efficient, then that means that they don't reflect all information, and the key implication would be that there would be a potential benefits from insider trading. Again, it's illegal and unethical, but if one had access to private information, one could predict where certain stocks were headed if they knew that there was this good news or this bad news that hadn't been made available, and therefore wasn't reflected in the current price of the asset.